Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter Paul Peebles. And joining me today would be the governor, the mayor of Beckerville, the smartest guy in the room, Mr. Michael Becker. Unfortunately, he's on another due diligence assignment, so we wish Mike and his group over at SPI a lot of success. In the podcast today, sitting in, the professor himself, Mr. James Eng. James, how are you?
Great. Thanks for having me today, Paul.
Thanks for hanging out with us. We appreciate that. What's going on in the Old Capital world, James?
I think the big thing is we're having our big conference in October. So October 24th is our sort of annual conference. We bring everyone together, all of our buddies in the listing broker world, the property management world, all come together, and we really just figure out what's going on in the market and also give you a chance to network with all the players. And so that's coming up. So definitely save the date for that one.
Go on to the oldcapitalpodcast.com website, oldcapitalpodcast.com website. Again, I think the key word in that last sentence James said was network. Network. You're going to be able to network with 700, 750, 800 of your closest real estate professionals and friends all throughout the United States. So jump on an American Airlines jet, jump on a Southwest Airlines jet, come on down to Dallas. We'd love to see you, spend some time. Last year, we had it over at AT&T Stadium where the theme was get in the game, get in the game. Yes, we rented out AT&T Stadium. We had Roger Staubach as our keynote speaker the year before. We had about 450, 500 people with hearing Rob O'Neill. We talked about teamwork. You know, Rob O'Neill is the Navy SEAL that shot and killed Osama bin Laden. Great information, a lot of interesting facts. You know, how as a team member, he was able to get into Pakistan and make that shot. So great information comes out of a lot of these meetings. We have rented the House of Blues. And so are we ready to announce who our keynote speaker is yet, James?
Not quite yet. I mean, I think the keynote we usually have in the afternoon, but we're putting together our speaker list now. And so we will let you know slowly who that will be, very slowly.
So again, we'd love to see you come to Dallas on October 24th, 25th, and participate with us. We'd love to see you there and have a chance to break some bread with you. Also, two things I want you to remember. If there is a question that you have concerning operations, remember to ask Mike Mondays. Ask Mike Monday. Mike wants to answer your question. So go on to the Old Capital Podcast and type in what your question is, and we'll get that into Mike's hands so he can answer that question. The other thing I want you to remind you of is go into the 17-page white paper report. James helped write that report. Talk a little bit about multifamily financing. Multifamily financing is important. So again, Old Capital, we did over $1 billion. So we are a little bit knowledgeable about how these deals get done. $1 billion in 2018. James was a big part of our success. So he wrote with us a 17-page white paper report about how to finance apartment buildings. And then you also have a couple of videos too on the podcast.
Yeah. I mean, I think a lot of times you can read something, but then also seeing pictures, seeing, loan agreements or green reports or all these things that go into the loan underwriting process and sort of talking through those can prepare you to be better prepared for the loan process and then also more knowledgeable about what loan products are available for your particular deal.
James pulls the curtain back and gives you an opportunity to see exactly what's going on behind the works. So we love that. In the podcast today, we're going to talk a little bit about bridge lending. And this is kind of an interesting piece right now because bridge lending, because these prices have gotten so high throughout the United States on sales prices, Fannie Mae has been, now they could do up to 80%. They could do up to 75%, but because the prices have gotten so high, we're starting to see Fannie Mae quotes in the 65, 70, 74% range. Even though they could go higher, they'll only be able to qualify for the lower amount until you go in there and you take over the deal and you fix the problems, change management, rehab the property. So today we're going to talk a little bit about bridge lending. Why is that important, James?
I mean, I was actually a bridge lender back at G Capital, and sometimes people would bring us apartment deals and we were always like, why are they coming to us? Because we were more expensive. So bridge loans are more expensive, but then what the bridge loan is going to give you is more leverage. And so if Fannie and Freddie are looking for a 125 debt service and your particular deal doesn't work that way, or if Fannie and Freddie hit their caps, then their spread might increase, which is going to increase your interest rate, which might not get you to the same leverage point that you want to get to.
Oh boy, you brought up an interesting point about the caps. So Fannie Mae and Freddie Mac have caps, which means that's the maximum amount of loans that they can do in any 1 year. And that's about $36 billion. So Fannie Mae has 36, and Freddie Mac has $36 billion for 2019. Well, here's the kicker right now, and this is not so much a problem today, but it could be a problem in the fourth quarter 2019, because right now, if they're doing, say, $36 billion is the maximum amount of Fannie Mae loans, they're at 21.7 billion by the end of April. Now we're at the end, getting close to the end of May. So I'm thinking they're closer to about maybe 25, 26. So they're running out of money right now to fund your loan. So this is kind of a timely topic, because if Fannie Mae, for some reasons, has a hiccup and you are thinking about trying to do a Fannie Mae loan and they can't, we will probably be talking to you about bridge lending. So I think that's very important, very topical right now.
And you might get hit with a double whammy because interest rates are super low right now. So if interest rates go up and then Fannie Mae says, well, we're not going to give you as much improved pricing, so your spreads might go up. So you get hit with higher interest rates, higher spreads. Then all of a sudden, this bridge loan looks a lot more and more attractive.
So in the podcast today, we're going to talk with one of our bridge bankers. In fact, we want to keep his name kind of undercover, just between you and I. Let's call him John Q. Banker. John Q. Banker. And so we're going to ask him a series of questions about what's going on, what you should be looking for in a bridge loan, and if this is a good transaction for you to do in the future. So I'm going to turn this over to James, and let's just get this conversation started.
So John Q. Banker, welcome into the show. Glad you can make it in today. Maybe start off with a high-level overview of bridge lending.
Sure. Thank you. Good morning. The bridge lending for us is more traditional properties that are cash flowing, primarily apartments. We also do other properties such as office, retail, hotels. Primarily we focus on apartments. We're looking for something that's in transition. It's going from one to another. So in other words, you're taking a property that's a B or a C, and you're going to put some money into it over the shorter term and try and push rents $100, $200 or so as you increase the property's scope or appreciation in the property market from a B to an A or a C to a B.
And so what are some of, maybe give us sort of the box for bridge lenders in terms of leverage, interest rate, term, that type of, just to give people a framework of, okay, that sounds great, but what's it going to cost me?
Sure. Generally, we're looking for a shorter term play, so a 3-year interest rate term plus 2 1-year extension options. So up to 5 years. Most of the time, it only takes 18 to 24 months to turn the apartments over. It's a non-recourse loan. It is, so if there's a problem, there's no problem going back to the borrower at all. We're leveraged. We're going to be 80% of the purchase price, and we're going to be 100% of the CapEx, and we future fund the CapEx. So there's no negative arbitrage on the money you're not using today. So you don't pay interest on something upfront that you're not using. So then the funds later on, you don't pay until 6 months or up to a year later.
Okay. And then, is this for the borrower that maybe it's their first deal, second deal, third deal, because it is a non-recourse loan? What type of borrowers qualify for a bridge loan?
For us, we're looking for 2 or 3 deals at least, not the first-time borrower. We'd like to see some experience in the markets. In other words, if you're doing all your deals in the Northeast and then you decide to do your first deal in the Southwest, better have a great reason or compelling reason. We're looking for someone who's been to the dance before, who can show some acumen in going ahead and executing a business plan, and maybe we can show that has done it before and had success. Doesn't have to be a long track record, doesn't have to be thousands of units, but at least 100 or 200 units that they've owned before.
And is there an example of maybe a borrower that you worked with that was able to show this well? Like a lot of times we ask people for resumes, they might send us a Word document that just sort of outlines their properties. But have you seen like a good example of this that maybe got your credit committee comfortable on a borrower?
Oh, sure. There was a recent deal I did in Memphis, Tennessee, where the borrower had done another property and taken it, and from start to finish, and another year earlier, he had taken a property and said, here's what I bought. Here's how I fixed it up. Here are the rents now. That's my only property I've done so far, but here's what I've done. It's literally within a couple of blocks of the next one I'm buying. So we got comfort, even though he didn't have a long resume, he had done this in the area and he had executed his business plan. It was really, he could show that he could deliver, because my company's bank is coming in and giving someone non-recourse money. We want to be confident that we can be refinanced out in 3 to 5 years to a permanent loan. And we have to rely on the borrower executing his business plan. That's really kind of the key to this, is executing his business plan. If he can do that, great. And that's what we're looking for, is people who can come in and take something, polish up, make it a little better, add value.
Yeah, I mean, I think a lot of times with Fannie and Freddie, they really look in the rearview mirror in terms of the operations, whereas you guys are looking a little bit through the front windshield and trying to understand the story, understand how you're going to get me from A to B. We touched on this a little bit, but in terms of properties, I know you guys do, most bridge lenders sort of work across the spectrum in terms of properties, office, retail, industrial, multifamily. Similar, I did, when I was the loan underwriter at GE, I did very similar product, but let's maybe focus in on multifamily. And what are you seeing a lot of your multifamily product on the bridge side? What type of properties typically qualify for a bridge loan?
My firm focuses more on stuff that was built in the 70s, 80s, or 90s that needs a lift of at least $5,000 a unit going into the CapEx. It's harder for us to believe that something where a borrower is only going to spend $2,000 or $1,000 is actually going to get the rent pop needed to go from a going in debt yield in the 5% range to something that you can get us refinanced out through an agency with at a 7.5% to 8% range. So that's a number we're typically looking forward to going in, is 5,000 unit in CapEx, and something that's newly built in the past 2 years or 3 years doesn't need that. It's pretty much brand new. So something that does not work for us is a recently built property with no CapEx going in because it just needs to burn off concessions or lease up. That does not work for us. We're value add. So we're looking to take something that on a scale of 1 to 10 needs to go up a notch or two, and not something that's already there. And what we're looking towards the future in 3 years, how's this going to look? What's realistically going to look like? We're going to look at where we think taxes are going to be. That's one of the bigger things on reassessments. We're going to look, and maybe taxes aren't reassessed in the first year. Maybe year 2 or 3 after the value add, they will be. But we're going to look at a snapshot in year 3 or 4 of where we think the income and expenses will be. We'll hire an appraiser that we'll discuss with you who we use or who's smart on that. And then we'll go ahead and engage them and make sure they buy off on those assumptions for underwriting so that in year 3 or 4, we can be comfortably taken out.
So you said 2 words there, debt yield, which not many people are familiar with. Maybe give us the definition, and how do you guys look at that, and why do you look at that maybe compared to debt service coverage on a deal?
Okay. For us, debt yield is the property's income minus the expenses, and we're typically using on underwriting the trailing 3 months of income annualized, and expenses, we're underwriting what we think the borrower will operate this at the first year in expenses. Property taxes, they're reassessed what they'd be, a management fee typically of 4%, and then a replacement reserve of typically $250 a unit. We're taking that number as the net cash flow. We're dividing that by the total loan amount fully funded. If we fund $6 million day one, but another $1 million over the first year, there is no debt service coverage or covenant on that money. So we were going to have the entire loan amount be in the denominator and the net cash flow, the numerator. There's no hurdle that you don't get your money, period, along the way unless you're not paying us. Then you're in default. Anything short of default, you've got the money. That's why we focus on that. We will occasionally build in interest reserves. If your LIBOR coupon today LIBOR is about 2.4%. And if for make numbers a little easier, if your spread is LIBOR plus 310, your interest rate would be 5.5%. And if we have a debt yield of 5%, then we're showing the loan does not cover day one, fully funded. And so what we're going to do is build in an interest reserve to cover that shortfall. We're not looking for a huge interest reserve, and we're putting in something so that the borrower has the ability to draw upon that to be able to cover any shortfalls. And if he doesn't use it, he has the opportunity to get it back out fairly easily.
Okay, so when you guys are looking at debt yield, you're really looking at net cash flow divided by your total loan amount, and that might be year one. So going in, you might be at a 5%.
Right.
But really you want to see sort of year 2, year 3, what is my NOI going to grow to, or net cash flow going to grow to, divided by my loan amount to get me to a 7 or 8% debt yield on the exit. And then so the borrower can either sell the property or refinance the property.
Yeah, exactly. I mean, there's some markets where if you're, say, in San Francisco or Austin, the debt yield can be a little lower in year 3 or 4 because it's easier for you to get us refinanced out than if you're at a much older property in a sort of secondary, tertiary market. The debt yield definitely needs to be 8% or higher just because it's a little harder to be refinanced out.
So a lot of our investors and borrowers who listen have done a lot of Fannie and Freddie. And so they're familiar with sort of that non-recourse program. What would you say some of the big differences between Fannie and Freddie loan versus you guys and a bridge lender in terms of maybe leverage, CapEx, exit fees, things like that? Like how do you, when a borrower is looking, let's say they've already done 3 or 4 loans, they've executed the business plan well the last couple of years. Now they're coming into 2019 and saying, all right, maybe I should be looking at different loan options besides Fannie and Freddie. When would the best case be for a bridge loan?
Well, we typically compete and win against Fannie and Freddie. They're excellent lenders. I've been in my past career, I've been a Fannie Mae, Freddie Mac lender and a borrower. So I've been on both sides. So they're excellent sources of capital. But where we're different and probably a little more better choice is if they need non-recourse, higher leverage, and they expect a significant increase in rents so they can turn around within a year or 2 and have little to no cash in a deal. So in other words, on an agency deal, there may be some dropping in occupancy. And one of the bigger things I see in office in many deals is occupancy drops because the property manager likely is not going to be retained and it's been chugging along at 90% occupancy for years. And then it drops a little bit as the property manager has not been told that he or she is going to stay and he or she is looking for another job. And all of a sudden you come up and it's 80% occupied. And for an agency lender, that's a huge problem in terms of proceeds. I've had to step in a couple of times where agencies could no longer get to the original quote and been asked to close very quickly in 3 weeks or so because the borrower needed more proceeds. We're a little less sensitive to that. We look to close quickly, but the debt yield doesn't have to be as high. And if we're expecting a significant amount of CapEx, 5,000 a unit or more, there's a chance for the borrower very quickly within 2 years or so to come back and refinance this out. Just about a week ago, I was financed out of a bridge loan that I had done in 2017, where we had given the borrower $16 million on a total cost of $21 million. And he executed his business plan and he sent me an email saying, John, what is my return on equity? I just closed a Fannie Mae loan for $23 million. I have no cash equity in the deal. And he was thrilled because now 2 years later, he has $1.5 million cash out net of it, paying his mortgage banker and everything. And his return is infinite. And he would not have gotten that leverage originally from Fannie or Freddie. He would have been locked in with the yield maintenance prepayment. For us, we only have an exit fee for the prepayment. We also have a minimum interest or spread maintenance, typically 18 months. So it typically takes most borrowers at least 12 months to get the money out into the property to renovate the units because they're tenants in occupancy. And then they want to churn the rent roll at least one time. So it's typically an 18 to 24 month period for people to execute their business plan. And we don't want to do all the work and fund on a Monday and be told, Tuesday, here's all your money back. They can do that if someone gives them a ridiculous offer. So they're not locked out. There's no lockout. We just want to be paid a minimum interest or minimum spread. So
you've got higher leverage potentially if the deal is debt service constrained on a Fannie or Freddie. You've got your CapEx funding at 100%.
With no negative arbitrage.
No negative arbitrage. And then you have, let's say, 1% exit fee, 0.5% to 1% exit fee. So those 3 things are all sort of key advantages over your Fannie and Freddie debt. And you touched on one point, I didn't even have it in my notes here, but the timing.
Yes.
Because I remember when I was at G Capital as an underwriter, we would win deals because we told the borrower we could close in 21 days.
Right.
So how do you, so Fannie and Freddie take 60 days, typically 45 to 60 days. How are you closing in 3 weeks?
3 weeks is an exception. I shoot for 30 days
30 days,
typically.
okay.
I'm going to have a kickoff call and get a 2-week turnaround on your engineering environmental appraisal. We'll make sure we have the borrower up front ready with his organizational start. Because we're a bank, we have to run certain searches on people. We make sure we get that out of the way very quickly, and we are very upfront what it is that we do. I also typically like to go see most of the properties myself, or I have a senior member of my staff see it right away. So if there's any issue, we can get on top of it and tackle it and make sure there's not a problem and coming up to the last second. So if we vet everything up front, most of the apartment deals markets, there are very few times we're going to a new market where we've never been. Because we're a national platform, do business in every state. There's rare exceptions where we're into a market for the first time where we have no background, and then we can still get that very, very quickly. So yeah, I typically try to go for 30 days and make sure the borrower has a seasoned attorney who's done commercial real estate loans. If they have a good team, we're ready to go with them, and we'll get there.
So once you guys get the third parties back, the underwriter sort of puts the package together, sends it into your investment committee. Can you, at a high level, talk about investment committee and time once they receive it to get approval on a deal?
Sure. Typically, before I can send an application out, I have to have gone to my group head, who's a senior member on the investment committee, and he looks at the write-up when it comes back later on. As long as the terms are very similar or better, sometimes, or within reason, the deal's basically approved, subject to other people in the bank looking and saying, have you done your know your customer? Does the committee sheet match what's in the loan documents? Basic stuff like that. When we get him a committee sheet, we typically, if we get an appraisal and everything in on a Friday, our analyst will write up everything by Monday. We'll give it to him on Monday afternoon to review. He'll make edits, have a committee on Wednesday, be ready to close on Thursday. So it's a very fast period.
So higher leverage, CapEx funding, low exit fee, quick closing. I love it. It hits all the boxes. So tell me about maybe why someone should not take a bridge loan and maybe some of the disadvantages of bridge loans, because it doesn't work well for everybody. And so I wanted to, maybe you can touch on some of those things that you've seen. Deals
typically we don't like as much on the bridge side that are better is if someone has a bridge loan, they want to refinance. We typically don't go bridge to bridge. That's one. If you've had a property that's not doing well and you're the borrower, maybe it's on you. Okay. That's being direct here is because you're
so a refinance.
We do them.
Okay.
We do them. I'd say, but they're less than 1 in 10. Okay. We do them because they want to sell in year 3 or there's a partnership buyout. There's something going on, but the property already has a debt yield north of 7%, because if it's in the 5% range and you've had it 3 years, clearly, maybe you should think about selling it. We're not a big fan of that borrower continue to operate it and continue to think they're going to continue to improve. That's one reason. Another reason, if they want to go ahead and lock the interest rate, our interest rate floats, and we do have an interest rate cap. But if someone's going to hold it long term and they want to go ahead and fix in an interest rate right now, and they think their crystal ball says that in 3 or 4 years interest rates will be much higher, it makes sense to lock that rate in now. I don't have that crystal ball. Otherwise, I wouldn't be here. I'd be on the beach somewhere, retired. So I don't know where interest rates are going to be, but some people feel strongly one way or another. I've generally been wrong when I guess on where rates will be because they've stayed low for a long time. But someone believes that they're going to really rise in 2 or 3 years and lock it in. That's a great thing to do now, because I don't offer that. I offer a floating rate product. But the flip side is the prepayment. We're the half point out. And agency is the yield maintenance. For if you come in 2 years, we can be paid off much more cheaply.
On the floating rate, talk about what your typical spread over LIBOR just in general is. And then also, what do you lock? So you have a 3-year term. What are you locking when you go out to the market? And how much does that typically cost?
Right now, for loans $10 million and above, $290 to $300 over typically for a very good, strong market. I'd say for loans under $10 million, you're LIBOR plus 310 and up. It'd be a rare case to be above LIBOR plus 350. It'd have to be a very hard deal in a smaller market with a tougher borrower.
So your all-in rates right now, let's say LIBOR you said was 250, so 5.5 to 575 in that range, just depending on the market. Okay. And then what do you go out and lock, and how long do you have that locked in for?
We don't lock. It's a 30-day LIBOR. Our loans price over 30-day LIBOR. Okay. And what's going on is our spread is locked in and LIBOR floats. There's one question, I don't know if you want to get into it here, is what happens when LIBOR goes away, because it's projected to go away. We can discuss that or we cannot, but I'll just say how we're handling it. We're not the number one or two bank in the country. So we have in our loan documents is that when and if LIBOR goes away, whatever the generally accepted replacement rate is becomes a new index. So instead of LIBOR, maybe the federal funds rate, and we adjust our spread up or down so that you have the same interest rate the day that LIBOR went away and the next day. So if you're paying all-in rate of 5.5% on Tuesday with LIBOR and then Wednesday it's gone and it's replaced, we adjust the spread so that you're paying the same interest rate on the new index the next day. So it should be hopefully seamless to the borrower. And we're trying to follow what the overall market does. This seems to be generally what's done. But this is a question we get from a lot of people on what do I have to do on a LIBOR loan, because LIBOR may not be here in 3 years.
But okay, let's just assume LIBOR is here for the term of your loan. Sure. Then let's say your current LIBOR is 250 basis points, and your spread is 300. So you're all in at 550. What cap do you put on LIBOR typically? Is it 100 basis points, 150 basis points? What's your typical?
Right now, loans, a lot of people believe LIBOR is not going to go up. So the LIBOR caps have really come down. I closed a couple of loans in the past week or two where LIBOR caps for 3 years at 3%. We're in the $15,000 to $18,000 range. That's insurance for the borrower and for us. So if for some reason we're wrong, the market's wrong, and LIBOR becomes 5%, well, they're capped at 3%. And that has happened on some loans I did 3 or 4 years ago where LIBOR used to be a lot less and borrowers were getting checks in the mail every month. So some people who were not happy about the cap cost are now very thrilled that they're getting checks every month.
So who pays them a check? I guess if you buy the cap and it goes above, let's say you cap
it's the counterparty. It's the counterparty. It's the counterparty pays that. So they're collecting as long as LIBOR is below the 3% interest rate cap. They are basically it's insurance that they're getting as the counterparty for the insurance.
Okay. And then you guys are comfortable capping it at 3%. Do you look at a debt yield or do you look at a debt service coverage? What are you looking at to sort of determine where you want the borrower to buy their cap?
I'd like to look and say where can they realistically be on a stabilized basis, at least at a 120 coverage. So we'll have our caps typically at 3% for year 1, 3.5% for year 2, 4% for year 3. Occasionally, we'll modify that if it's another product type, because for a hotel, the debt yield will be significantly higher. But we're trying to keep the borrower's costs reasonable and low, and their insurance costs for that very reasonable, and protect everybody.
Right. So we talked about sort of the term of the loan is typically 3 years, 2 1-year extensions. You have floating interest rate. Talk about 2 things here that I have on my notes here in terms of sort of application fee to get the deal started, and then the loan agreement. So sure. Those 2 things, and then also the lockbox. Sure.
Yeah. As far as the application, we, compared to some agency lenders, we're going to include the legal deposit up front. We're going to be $50,000. That should include underwriting, engineering, environmental insurance, reviews, site visit, and legal. The agency is going to be a little less up front, and then they're going to hit you later on for a legal fee. And our loan docs are more negotiable than the agency loan docs are. So we can have some more negotiation on that. And we have one feature that's very different than the agency is that we're going to have future fundings. So there's going to be some negotiation there on CapEx as is funded later on, putting in language so that borrowers can have a plan today that can be modified after closing, because that's something we work well with is people come in and they have one plan up front, and then they come in and open up the walls or get into the due diligence as an owner and say, wait, some of these ideas I want to change. This is a bad idea. Something else is a better idea. And we'll work with them. So we have to have that flexibility. As far as a lockbox, we have a springing lockbox. There's no lockbox day one. It all goes to the borrower's operating account. We have certain triggers if you go below 4% debt yield in the first 2 years, in which case you're significantly under coverage for a 1.0 coverage. You're endangering of inspect the property. If there is any event like that, if there is any cash flow, it would go into a lockbox. There's normally no cash flow to go. Or if there's a trigger event, such as the borrower tries to do something that's a bad boy carve out, he tries to sell the property or take on a secondary debt that he's not allowed to explicitly done. Our loan application will generally lay out the terms of the deal very well and much detailed, and that those are easier to mirror on the loan documents later on.
Are there any, on Fannie and Freddie, the deals seem pretty similar. There's, 90% occupied for 90 days. net worth and liquidity covenants, pretty standard across Fannie and Freddie. Yeah.
Our liquidity cover are significantly less than theirs.
Okay.
So we're looking for a 50% of the loan amount. So if, in other words, a $10 million deal, the borrower, the key principal needs to have a minimum net worth of $5 million. As far as liquidity, Fannie Mae is typically looking for a year or 10%. We're looking for 5%. Okay. So for your $10 million loan, a $500,000 liquidity and a $5 million net worth will work. I will just caution some borrowers that that's for us. When we want to be taken out, we're not the takeout lender. The agencies still have theirs, but we can help you get in. Maybe you want to sell, but for a refinance, be aware of that.
Okay. It's there. Most bridge lenders cover all property types.
Yeah.
Are there any unique transactions, let's say in the last 6 to 12 months, that you can give us maybe a high level story on, or something that you didn't see every day?
No, I don't typically see. There's a transaction I recently closed in the state of Texas, big state, so I don't want to give away the specific deal, where someone had it under contract and then they decided in the middle of their due diligence that instead of just fixing up the units, that some of the units were so large, they wanted to take the 2-bedroom units and make them to 3-bedroom units. They wanted to do it across the property types. This is when we closed in 35 days, so we had to figure out if that was realistically something they could do legally. And then they also had an investor partner they wanted to come in that had 1031 money that was a TIC. This was not contemplated or tenant in common. So it's a different ownership than a typical LLC. And we end up with a TIC borrower. The other owner who had the 1031 money was trying not to sign the carve-out guarantees that he was required to. So we had a large discussion and found a way through that where he had to bring in a manager of the TIC. So we figured that out, got it done, and they have all their money now and they're executing their business plan. It's going very well.
So I think the key thing here is flexibility.
Yes.
I mean, as a bridge lender, you're going to have, or when you go with a bridge loan, you're going to have flexibility in how you structure the deal, how your loan agreement's going to look like, who your borrower is going to be, and then you can pretty much buy any property if you have a good track record.
Right.
Versus Fannie and Freddie, they're going to look very heavily at the property. And if the property doesn't qualify, it doesn't matter how great of a borrower you are, it's not going to work. So we've really talked about starting the loan, getting the loan closed. So what happens after a loan is closed for you guys? And then also, I mean, you can talk in general for bridge lenders.
Sure. We will typically do, after a loan closes, we're going to sit down and have a call with the borrower just to walk them through the asset management with our head of asset management. She sits on my floor probably 30 to 40 feet from me, and she's very good to work with. A lot of the people come back to us for second and third loans just because they work well with her, and she's very flexible on alterations to the original business plan. And so she gets all the money out to people. As far as the reports, we just get the normal reports in for quarterly reports. Normally, we put these into a CLO or a collateralized loan obligation and pull the loans for securitization that's only with us in the pool. And then we have the consultation rights afterwards. If there are any major decisions, we have a seat at the table on that. Typically, there aren't any. It's only regarding the future funding that we wholly control. So if they have any issues, they come back and call me or our head of asset management, and we can help them with whatever they're looking to get done.
Okay. Any final advice maybe for investors looking at this option who maybe have a couple deals under their belt? Any final advice for investors out there maybe doing their first bridge loan in 2019?
Yeah, sit and talk to your mortgage banker at length about the positives of it. The real challenge here for the agency loans is they will limit your upside for the first 2 or 3 years. If you believe there's real upside in the property you're buying for the first 2 or 3 years, then you want a second buy at the apple where you can pull your money out. And a supplemental loan won't necessarily let you get all your cash out so quickly. And we will, because you can get us refinanced out very quickly. We'll give you more money. Typically, all in, we're at 85% of the total cost between acquisition costs on the purchase price and the CapEx. It's 85%-ish in that range. So we have more money for you there. And we're very flexible on this. So that's it. I appreciate it very much.
Thank you very much, John Q. Banker.
All right. Thank you, James.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.